The real life example that I wanted to talk about today with respect to commercial mortgages is the two types of commercial mortgages that are generally in the marketplace. There are commercial mortgages to help you buy a commercial property for investment purposes, and then there are commercial mortgages for commercial properties that are going to be purchased by a business. And so we call those owner-occupied purchases versus investment property purchases. And the difference in interest from the banks is pretty significant. Some banks will only fund commercial mortgages for businesses that are buying a building and will want nothing to do with providing mortgages on investment properties. And conversely, there's banks that only want to provide mortgages on properties that are being purchased for investment only, and they do not want to give mortgages to businesses who are buying a commercial property. So not every bank is the same. Every bank has a different kind of client that they want. Some banks want investor clients, some banks want business clients, and so it's important to know that when you're going to approach them for financing. There's a difference in loan to value. If a property is going to cost you $1 million, some banks on an investment purchase basis will say, well, we only want to give you $650,000, or maybe we're okay to go to $750,000, versus giving a commercial mortgage to a business who is purchasing a property. Sometimes you can get 100% financing depending on how the deal gets put together. So the amount of equity or cash that the borrower needs is different depending on the type of commercial mortgage that they might be choosing. The way in which a bank will determine the approval is different as well. In the investment property example, they'll look to the net worth and the rent roll from the property to determine approval, versus a business looking for a commercial mortgage. They'll look at the financial statements for the business and say, can this business afford this mortgage? And so in both cases, the bank wants to see the income, but how they look at the income obviously is going to be different. And if you're going to approach a bank, it's important to understand which type of commercial mortgage you're looking for. And if you're going to be talking to them, then say, is this is this mortgage the type of mortgage that your bank likes to fund? And if you ask that question, a lot of times the banker that you're dealing with will be honest and they'll say, look, it's not really what we do, but we're happy to do it for you because you're one of our customers, but the interest rate may not be as competitive as if you maybe visited with some other banks, because it's really not the type of property that we like. And you'd be surprised, that happens quite often. So those are the two types of mortgages that we see all the time, and it's important for you, the borrower, to understand which one that you're going to be looking for, because the criteria, the income, the process can be considerably different for each, and it's just good to know that in advance. You can visit emilynow.ca to see what the difference would be. When you go through the tool, it'll give you the option to say, is this mortgage for your business? Yes, no, and if you answer each differently, then you'll see the different criteria and what it looks like. So good luck with that, and hopefully we can help you.